I think for the retail investor who's looking at a customizable fund, they don't have to invest in every asset that's brought in front of them. That's the biggest thing. So your listeners and watchers may not understand the blind pool, but when you hear a fund in the industry, syndications, let's say we have an apartment syndicator. If they get big enough, they're going to try to save money by creating a fund, which means they only pay their lawyer once. And then the fund may have anywhere between 3, 5, 10 assets inside the fund. That's a blind pool. You don't really get to decide if you don't want that deal.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast series, The Allocator, a new way to finance real estate, all about the newly emerging capital allocator world. Welcome to today's episode. My guest today is Kent Leach of Hickory Creek Capital Partners. What a lovely fellow Kent is. He is, well, you're going to learn he's a PT. He's also been doing some development work over the last few years in one of the hardest real estate asset classes. So kudos to him for that. You'll learn a little bit about that. But what you're also going to get into in much more detail is the capital allocator model, how Kent was attracted to it, how he set it up, what are the pros and cons, what are the challenges he sees. It's a very interesting conversation. And if you stick around until the very end of our conversation, you'll find out what really remarkable and charming thing it was that almost postponed our recording the podcast today. If you want to learn more about Kent, go to GowerCrowd.com and go to the podcast page. I'll include links to him, his LinkedIn profile, maybe his Facebook profile, as well as he does some stuff on Facebook. And while you're there, do please also subscribe to my newsletter. It comes out every week. And I am sharing some of my experiences in real estate to provide context for the decisions that I'm going to be making for investing in real estate in the coming months. So all there at GowerCrowd.com, hit the subscribe button. All right, that's it. Let's turn it over now to Kent Leach, Hickory Creek Capital Partners. Kent, how nice to meet you. I've seen you a few times in some of these conferences we've been on or some of these calls we've been on together. So it's really nice to meet you. Thanks for joining me today. Let me open up with, you've got an interesting background. You do a few things. You're a capital allocator, but you're also a developer. So why don't you tell me what you do for a living? Why don't we start there and then we can work from there to other topics.
Yeah. Well, absolutely. Thank you, Adam, for having me on. I do have an interesting background. A lot of people don't know I was and still am a physical therapist, actually. We have a business that we run from our home that takes care of people in the rehab space. But I started developing affordable housing, started working on that about 5 years ago. We recently just cut the ribbon on a new development. And actually, it's an adaptive reuse of an old building. And we took advantage of scored some points in 9% LIHTCs and were able to win those credits. And unfortunately, that was right before the pandemic hit. So that deal took a full 5 years to bring to fruition. But I don't know if it's a side gig, but I'm a capital allocator. Last year, I launched my customizable fund. I call it my Smart Flex Fund.
Right.
And we have almost, I think we only have about 15 investors, but I raised almost $2 million last year in the fund's first year of existence. So we had a really successful first year in the fund.
All right, good. So let's talk about that. By the way, you might have found that my volume suddenly spiked because I realized that Zoom, in its infinite wisdom, had set it to some really low levels. I forgot to check that before we started. So apologies to everybody if I suddenly went really loud. You, most importantly, Ken. All right, fine. So you started it. So the LIHTC stuff, I mean, that's really sophisticated. And to have the patient, I know exactly, I see you shaking your head in agreement. And I know it's brain damage and it's a lot of work, very complicated stuff. But let's definitely focus on the allocator story. So What what drew you to doing that? You've got a business, a PT business. My wife's an OT, by the way,
Yeah.
so I am quite familiar with that world. But so what drew you into that business? Why on earth would you want to do that when you've got successful PT business and are busy building and doing affordable housing uh, developments and entitlements, which sounds like
Yeah.
a lot of work.
Adam, I was already investing. I started flipping houses probably 25 years ago before Y2K. And so I was flipping houses and I was always looking for that side gig, a way to invest. And I've kind of over the years kind of graduated into that bigger deals. So and I also in my former life, I was around a lot of physicians, so I had a good investor base. Those investors trusted me. I was taking them into house deals and other type deals like that. And I just realized if I'm going to be vetting these deals, I'm going to be looking at all this deal flow. Why not bring my friends and family along with me? And really, it was a sobering thing because I realized these people really trust me. A lot of the base of my fund, they're friends and family. You hear that a lot, and there's a big responsibility when we take that money into deals with us. Um, but there's a lot of things that came together that made that. That jump really easy, but it's having deal flow, and I think I've solved for that, and then being able to vet those deals. I don't take that lightly, and I don't do that alone. So, and my investors love the fact that I'm vetting deals with other fund managers. We're vetting them together. And I like that too because my strength is probably not in the math in the numbers. But I've got friends who love that, who former engineers who love to dive into the numbers. And so I just feel like it all came together at the right time for me and forming a customizable fund was the way to go.
Okay, so let's talk about that. 'Cause you're using some terms here that I'd like to clarify. First of all, you said that, and actually, before we started, I said, no, no, let's not talk now. Let's talk on the podcast. So now's the time for that.
Yeah.
You mentioned um, that things, but you didn't use the exact term, but things came together that made it easy to get into the allocator world. So, what were those things that made it easy for you, Kent?
Well, are you okay with me just talking about specifics? I mean,
Yeah.
I found a host, a platform known as Avestor, which a lot of my I was getting on a lot of calls and doing a lot of Zoom calls, and I was hearing the name Avestor quite a bit. And Avestor is out of Portland, Oregon, and they were probably the industry leader in the customizable fund. I never wanted to be focused on one asset. I did start out my path into affordable housing started with vetting market rate deals in 2019. But I had some really experienced partners with me, and that was always important. And they started seeing the craziness in multifamily back in the late parts of 2019, going into 2020 in the pandemic. And they pulled me out kicking and screaming. They said, "We don't think this is headed in a good place." Now, of course,
Who
we
was saying that, Kent? Who was saying
uh,
that?
these guys were out of Columbia, Missouri. They were a group that kind of partners with high net worth investors, and they'll go buy an apartment building for you, and they'll vet the deal because they've got the track record in the past. They'll manage the deal, they'll find the deal, do the due diligence. It was almost a done for you thing, and I don't
Hmm.
know that they're even doing it anymore, so I won't mention their name, but they're out there. Those kind of those kind of groups are out there, and that really opened my eyes. That's why I ended up in affordable housing because of that experience. Of course, it took a couple more years, but honestly, they were right because it was in 2020, 2021 when a lot of these bad loans were made, right? So people were doing deals, they were stretching too far, they were taking interest rate risks and bridge loan risk, and those guys saw that, and you know, I'd like to say they probably did save me from making some big mistakes back then.
Okay, so you got into affordable housing. So, kind of your commercial real estate world or experience has been since you started doing that in 2019. Is that right?
Yeah, but I was always interested. I made some investments with other syndicators, and those deals did well. I just never, I got to the point where I didn't want to, I realized I didn't really want to do the headache, I mean, the headaches of management. I didn't want to be an active investor in that sense.
Mm.
And I knew I wasn't going to manage property, but I wanted to, I wanted to look at other asset classes, and I knew that multifamily was having a big run, but I knew it would also see what it's seeing now. So I wanted my fund to be asset agnostic. I use that term a lot. We've got four deals in my fund, and they're all very different. We have a
What
marina.
are they? Describe them. But before you do,
Yeah.
you talked about the customizable fund, which I will note to those who are uninitiated, does have I think it has a TM after it actually on the Avista platform. I think they've actually trademarked it, or at least claimed to have done. The customizable fund, what does that actually mean? How did you learn about it? What appealed to you? What is it to somebody who has got no clue what you're talking about?
So, like I say, I kept hearing Avester on some of the same calls that you're probably on, and I explored it, and I'm like, this is perfect. The way they do this, it's one ppm that's created when your fund is launched, and they've got attorneys who have looked at this platform and looked at this way of doing things, and then each time, so our investors sign that initial ppm. They don't have to sign it until there's a deal to be until they take advantage of a deal. So the first deal, they'll sign that ppm, they'll commit to that deal. But we also create what's known as a deal disclosure, and that has really got the meat of the offering in it. So our PPM is kind of an umbrella PPM. It says that my fund is going to invest in multiple types of assets, but that this deal disclosure will get into the real details of each individual deal, and it really is a lot about what I, as a fund manager, we are very transparent on what we take, where we take our profits, and it spells out the hidden risks of that specific deal.
And what does it mean, customizable, Kent? And I do know what it means, but
Yeah,
there's, people who don't. So just explain.
absolutely. I think for the retail investor who's looking at a customizable fund, they don't have to invest in every asset that's brought in front of them. That's the biggest thing. So your listeners and watchers may not understand the blind pool, but when you hear a fund in the industry, syndications, let's say we have an apartment syndicator. If they get big enough, they're going to try to save money by creating a fund, which means they only pay their lawyer once. And then the fund may have anywhere between 3, 5, 10 assets inside the fund. That's a blind pool. You don't really get to decide if you don't want that deal that's coming along, that you may not like the market that syndicator is going into, and you may want out, but you can't. You've invested in the fund, and therefore you're invested in each asset they bring into that fund. Customizable just means my investors get to pick and choose what they want. And from the very get go, that sounded great to me because some of my investors are looking for cash flow because they're just on the verge of retirement. Some of my investors are much younger. They're looking to double their money about every 4 to 5 years and grow it. And they're not necessarily as keen in on the cash flow part.
Okay, so it's interesting you say that. So let's kind of just talk through that because you've given me a sense of how to internalize what this all is. And as you know, I've been talking to a few people. I'm absolutely fascinated by this allocator sector of the industry that's emerged. So actually, with a sponsor, the sponsor has a fund because they are the principal in all of the deals that they do. So they go out, their team, they find deals, they finance them, and they bring them into the fund. And we work with clients that have all kinds of ways they do that. It might have sidecars, or you can invest in individual deals as much as you want, as long as you're in the fund. There's all kinds of permutations. But the primary difference is that the sponsor, in those cases that you described, is the principal. They're doing all the deals. They're the one that's managing all of them. In your fund, it's different, isn't it? In your fund, you've got multiple sponsors. So go ahead and kind of shed some light on that? How does that look? What does that mean exactly? It's
Well,
different,
yeah,
very different.
it is very different, and some people initially it could be a turnoff because another term for what I have is a fund of funds. So I have a fund that's going and investing in other funds or other syndications. So that can be a little concerning at first. But the way I look at it, hey, I'm an investor first. I'm out there vetting these deals on my own. I'm looking for investments for my own portfolio. So once investors see that and they say, "Hey, you're kind of on our side, aren't you?" Yes, I'm a limited partner with my investors, and we're going into a syndication or another fund together, and that requires a lot of trust and relationships with these sponsors. So we're going to do a level of due diligence that, and I'm going to refer to them as the retail investor. Those are the people out there that maybe they saw on Facebook, they saw an offering from one of those big operators that we all know. And the minimum investment is 50,000, and they're going into that investment by themselves, trusting in their own due diligence, because we all know those sponsors aren't going to just come out and show you all their warts right away. They're going to hide. Every deal has downsides, right? We know that they're not going to come out and show those. It's my job as somebody that's been investing for a long time to vet the deal not only for myself, but I'm vetting it on behalf of my investors. Now, in no way am I an advisor, but it's really easy for my investors to look and say, "Hey, if and I'm putting my money in there alongside or as the lead, they feel empowered to invest alongside me."
Right. It's interesting. And so that's what makes it a customizable fund is that you are able to bring not just multiple deals into a, first of all, you're not the principal. You're bringing multiple deals into the fund with different sponsors, different asset classes, presumably different geographies, et cetera, et cetera. And your investors can say, I'm going to invest. You said how many? Four in the fund so far, right? Four?
I've got four assets in the
Four
fund.
assets in the fund. So
Uh-huh.
somebody who wants to invest says, I want my money into these two and not in those two, or some permutation of that. They can do that, which is
Right.
not typically what you can do with a traditional, what's thought of as being a traditional fund. Okay, how do you make money?
Yeah. Well, when you have a fund like this, you're going to have fees. I mean, you're going to have expenses. It was probably close to $20,000 to form my fund. So, got to get paid somehow, right? So, one of the common things you hear on Wall Street is 2 and 20. So if you're trying to get into like a BlackRock sponsored fund or something, they're taking 2% in order to keep the lights on, right? And then they want a share of the profits, and they take 20. That's carried interest. You may have heard that's a term that came up during the election a little bit. Carried interest. It was on the chopping block for a while, but carried interest is taxed differently than earned income. But carried interest means that I'm going to share. If we pick a winner, if I choose winning sponsors and the deal wins, I'm going to share in that upside with my investors. So we may have it's all disclosed. Each deal may be different, but I may take a 1% fund management fee. So if somebody invests 100,000, I'm going to take maybe 1% there. That keeps the lights on, keeps the fund bills paid.
That's
And
every year, right? That's
yeah,
annual. Mhm.
yeah. Well, that's yeah, exactly. And then as the deals have success, I participate or I'll take some of the gain. Now, here's a real common misconception, Adam,
Mhm.
and is that my involvement is going to lessen the return of my investors. And it's really it's a common belief, and it's honestly not true because um, I work with other fund managers and we allocate capital together. So we're bringing sometimes checks as large as $2 million to a sponsor. And if you're a sponsor, you understand the value of getting somebody else doing all the hard work for you. That sponsor only creates one K1 at the end of the year. They don't have to manage my investors. They don't even know who my investors are. When I send my money in, it comes in as one check, and that's from the fund. So my investors stay my investors, and it really works well that way.
Well, hang on. You almost got there, but you didn't quite. So I'm going to
Okay.
help you get there because I think let's just back up a little bit.
Yep.
Okay, so you set up a fund. and you go ahead, your customizable fund, and you go ahead and you invest with sponsors and with in other people's deals, basically. So you bring in money to those deals,
Yeah.
and you charge somewhere between 1% and 2% for each one of those. I'm not sure how it works. You said 2%, then you said 1%. But inside your fund, what do your fund docs say? Isn't it? The fund is how you get it out of the fund. So what does your fund
Yeah.
say? Is it 1 or 2%?
Each deal, honestly, Adam, each deal can be different. And so I have each deal can have different fees, not just the fund and the PPM. The mother PPM may say that each deal will have different fees, and as long as I disclose them for that individual deal, I can change them. I can run a special deal. I can say, hey guys, I've negotiated a deal that's so good, I don't have to charge you any fund management fees. And oftentimes, instead of a 70-30 split, me and my friends are able to negotiate a 90-10 on this particular deal. And sometimes it's not another red flag, or another thing that people hear is 90-10. Who can afford to give away 90% of the deal? Well, we may go in and carve out $1 million of a $10 million raise. So that $1 million is a 90-10 split. Obviously, they're getting their 70-30 off everybody else or whatever side letters they have. But my goal is for my investors to say, Kent, if I go around you, well, I get a better deal. Can I get a better deal? My goal is to say, no, you're in the Costco of buying of investments with me, and I've gone and gotten an even better deal for myself and for you. And so by investing through the fund, we will hand them one big check for $1 million, $2 million, and they're going to give us those great economics all day long because of the
Okay.
time we're
So
saving.
that's what I was getting.
Yeah,
Okay. So now it's you've added a few layers to this that are, like I need
it's
to
deep.
unwrap a little bit. So we got a fund, different sponsors, different deals inside that fund. Your disclosures, right? This kind of special disclosure document will say in this deal is 1% asset a fee based on the amount of capital that has been raised for this particular deal by you, or 2% or nothing, depending on what it is. You also have a promote structure. You said 20%. So you also have a 20%. Just a yes or no, because I want to get back to the negotiated terms. You also have a 20% vig on the or promote inside the fund, do you?
Could be. Each deal's different, Adam.
Oh,
So
I see.
yeah.
Okay, so if
So
each deal is different, okay, so that's what I was kind of getting at. That's where I was
it's
thinking.
my opinion, Adam, that a capital allocator, 20% is pretty steep for a capital allocator. Now, if
Well,
you're
hang
doing
on, I need
direct,
to understand what that is. That's what I don't understand. So
yeah,
hang on a sec. So you go and you'll negotiate with a sponsor, for example, and you've given this one example. Let's say they're paying an 8 pref and their regular terms are 70-30, but you negotiate a 90-10, right?
yep.
So who gets that delta and where does your 20% come in? That's what I'm
Okay.
a bit confused about.
I'm going to do some math here. So let's say that we get that deal to a 90-10. And let's say that my goal on that deal is to get 10% as well. What it's doing is basically it's 90% times 90%. So that comes out to be 81% that's going to my investor, and I'm keeping 19. So there's two layers, yes, but my goal is with those two layers to make sure, because what was that original? You said 70-30 was what I had negotiated from. So I'm able to give my investor that delta of 11. I could probably tweak my keep up a little bit, maybe even get to 15%. We could do the math on that. It's probably going to be around 75, 74, and that's better than the 70-30 they were originally getting.
Got
So
it.
my goal with my investors, not everybody has to do the same, because we've got to factor in access. Would they have even known about this deal, Adam, if it hadn't come through my fund, my relationships, my networking? And I've got two deals that are going to be in another deal coming. I promise you, unless you are in the same calls that I'm on a weekly basis, you wouldn't have ever seen this deal. So
Okay.
that's another layer of
Added
advantage.
value,
Yeah,
exactly.
of added value.
Okay, so now I understand what you're saying because what I've heard from other allocators, it's just a different structure that you've got, is that they'll negotiate, call it, let's just use your example, 70-30 to a 90-10,
Hmm.
and maybe a 10% pref instead of an 8.
Hmm.
And they will harvest all of that for themselves or share some of it. What you're saying is you do the same thing, but the way that you do it is that your fund promotes your investors. You've got a separate carried interest, and that's how you get to that split, right? So you're basically doing the same thing, but your mechanism is through a promote.
Exactly. I want to bring value to my investors, and I see that in several different ways. Like I just mentioned, one of them, exclusive access to deals they wouldn't have seen. Number two, better financials on the deals that they can go get on their own. I want them to see that, and just the deal flow that we bring, and the due diligence that me and my peer fund managers are already doing. You won't believe how many investors I have, Adam. I tell them, here's all the due diligence for you to do yourself, and they tell me, Ken, if you're investing in it, I'm investing in it. And I'm like, whoa, okay, well, that's a lot of pressure, but I feel so good that I've done everything I can. Eventually, we are going to pick a loser. We all know that not every deal comes out like they say they're going to come out, but my investors feel, like we said, feel very comfortable with me, and I want to make sure that I'm doing everything I can, not only for my own money, but for the other money that's in my fund that's not mine.
So how do you find when you speak to sponsors, how do you find they react when you say, I want better terms and I'm going to bring money in? And what kind of sponsors give you 90-10s?
There have been deals that we had a self-storage deal that came to us. Adam, that deal originally was a 60-40 deal for their investors. So if you go directly with them, they wanted to work with us. They wanted to find a deal that worked. And, maybe they never come back. Maybe it doesn't end up being a good deal for them, but we got the 90-10 split with them. It created a deal that made sense for me to get involved in. Actually, we turned that deal down. And after a period of time, they said, "Hey, what would it take for us to work with you?" And it's like, we get to set those terms because we have a track record of bringing the money. Now, if we couldn't perform, that's a different story. But you would be surprised how many sponsors are willing to work with us because as a group we can bring bigger checks. And it is.
Hang on. So let me ask you something there, because this is where I'll just be straightforward with you, and this is what I'm trying to get to the bottom of. One of the most important considerations when investing in real estate, and I make this as, I state this, you might disagree, but is an alignment of interest. So if you've got a deal that's just a smoking hot deal and the terms are a 60-40, um, why would you not bring it to your investors anyway, right? Like if you are you what I'm getting at is to what extent is the split that you're offered a driver in your decision whether or not to invest in something?
I mean, we're always trying to get that. Yeah, right. But we're trying to get the better financials. Yeah, as a fund manager, you have to look at it and say, especially a newer fund that only has four deals in it. I was picky about deals that could help me make sure that there was something there for me to be able to keep the lights on for sure. Um, but I put out, I don't hold myself out to be a GP with those others. I'm always showing my investors that I'm aligned with them. We're not in any way on this GP, and I don't step over into that world where we know a lot of people have. And I actually promote the deal. Never promote the deal as being my deal or I have 1,000 doors or anything like that. I've never felt comfortable with that language. I'm getting off track here, but
Explain that to me. No, no, no. That's really interesting. What are you talking about exactly? Again, something I'm very, very aware of, but I just would love to hear it from you.
well, when I was doing my research, and it's still it's very prominent over the last 5 or 10 years, Adam, that when somebody needed to raise capital, when as these syndicators, let's just say apartment syndicators, as they moved up to bigger and bigger deals, they needed more equity. They needed to raise more capital. And they usually, by a certain point, exhaust their connections to how much capital they can raise. So it's very common over the last 10 years for them to go in search of co-GPs. And you'll hear the co-GP model is saying, hey, if you can bring, you have to be very careful with this. There's SEC regulations, and only over the last 2 or 3 years have people really started getting scared about the co-GP model because
What
the
is the co-GP model? And give me some examples of, or some extreme examples that you've seen.
I mean, an extreme example would be somebody giving owner or giving a part of the GP a co-GP piece for raising, let's say, $1 million. And let's say that the sponsor said, hey, bring me 1 million. And as long as you bring me 1 million, I'm going to give you this piece. Or some sponsors may have even said, I'll give you a percentage of what you bring, which is really getting into some risky situations with the SEC. The SEC is very specific about how capital raisers are compensated.
And have you seen that a lot? And those sponsors, how many co-GPs have you seen in a deal? Kind of, that's
You
what I
know,
mean by extremes.
I've heard through other fund managers that some deals would get up to 6, 8, 10 or more co-GPs. Now, at the end of the day, how much are they actually getting? And that's we have raised for 10,000 doors, and when you really look at it, there've only been a co-GP on those deals, and they were a co-GP with 5 other co-GPs. So there were 6 that we're splitting a piece of the GP. So we talked about a 70-30. So now we're talking about the 30, right? And they're getting a percentage of the 30. So when you're getting a percentage of a percentage, it can get pretty small. And when there are 6 people in the boat with you, that can get pretty meager, honestly. Not to mention you're bringing a lot of scrutiny upon the way you're doing business, and you're doing it for an amount of money that may not make sense.
Well, then the other thing that we were talking about there was the idea of putting on your website or advertising 10,000 doors or whatever. So it's kind of explain what does that mean exactly in this scenario that you just described? How does what does that look like?
I mean, I think it looks to me it's a little bit misleading if you're not the main sponsor.
Well, but what is it? That's what I mean. Let me say it, and you just. I'm trying not to put words into your mouth, but I want to get to the point here. You
Yeah,
look at somebody's website, and it says 4,000 doors, 400 million AUM, assets under management, 20 full cycle deals, and in actual fact, they've raised over the last 2 years $500,000, and they've invested teeny bits in deals that they are aggregating. It's like saying, we have 200 years of 100 years of experience, but there's 20 people
exactly.
there have all got 5 years of experience.
Yeah.
So that's what you're talking about, isn't it? And you see that
Adam,
a lot, do you?
I won't say I see it a lot. I know it's happening, and I think unless you know how to really vet a sponsor and ask the right questions, you may never know that. And
But
that's
is
what
that vetting a sponsor though? Because so a sponsor, so the sponsors that I work with, those are their numbers. That's what they've done. We have clients that have got 3 million square feet of whatever and $4 billion worth. That's who
yeah.
they are. What we're talking about is the way an allocator represents themselves, aren't we?
Um, Say that again. I'm not sure I understand. As an
Uh,
allocator, or somebody like me saying
that
that
they've got 400. Yeah.
yeah, I mean, I think it could be problematic. I don't necessarily agree with it. That's why I always make sure that I speak about deals from this, not really a third person, but from the retail investor side of it, obviously the LP side of it. And that aligns me with my investors. I'm never talking about doors or how many things. I will start talking about how many deals we've invested in and things like that as we build our track record as an allocator. That's probably going to look a lot different. I like to talk about how many asset classes we've successfully gone into and how that's true diversification. We can talk about that. I think some people's idea of diversification, Adam, is an apartment complex in Houston, an apartment complex in Dallas, and an apartment complex in Atlanta. To me, that's not true diversification. True diversification is a mobile home park in Tennessee, a self-storage facility in Arkansas, and though that's how you get an uncorrelated asset class or a portfolio that's totally uncorrelated from Wall Street.
So let me ask you this then. So let's talk about the allocator industry a little bit. So you've seen and see these practices that I'm not sure if you use the word, but oh, you do say misleading. It's misleading. So what kind of problems do you think? Why is that problematic? And let's just set aside that you shouldn't mislead when selling securities. I mean, it's you're in securities as well, but what is why is that a problem? And yeah, just talk to me about that for the industry, do you think? Or is it a problem for the industry? Or is it
You
just a
know,
problem for individuals?
I think each individual has to decide what they're willing to say and do in order to win investors. Transparency has always been one of my key principles. Um, just even with the Avestor fund, our deal disclosures are so transparent. I make sure that my investors absolutely understand how I'm being paid and how, because some of my deals have may impact their returns and have. Those are deals that just come in that are just no cash flow. We're looking for a 5 to 10x exit, and my involvement very much may cause that 10x to be a 9x. And I want to make sure transparency is key, especially when you're dealing with the SEC and the government. I've been in healthcare. I've seen people who weren't transparent about overbilling Medicare, and I've seen them go to uh, bill places that were had really small bedrooms, and they got all their bills paid for them. Why
That's
would
right.
you ever risk
Yeah,
that? And
yeah.
I love this industry. Why would you ever risk doing something
So
sideways?
who, right? It makes you wonder, but there's plenty of people out there doing it. So how do you compete with that? By the way, this is a conversation that I've had in different contexts. Probably 8 years ago or so, when we were talking about the challenge of competing against the IRR. This is way before anybody even thought about allocator, and Avesta was not even a twinkle in Badri Malina's eye or any of the other co-founders or anything. So years and years before that. And it was a big problem when general solicitation became legal in 2013. But how do you compete then in a world of allocators, right? Let's just use that term for the generic term,
Mhm.
who are inflating their numbers and aggregating numbers to make them to be more attractive to investors. How do you compete against that?
I'm not sure I even want to be in that game with them, Adam. I mean, I want to be on a different playing field. I think what we do is totally different. I bring so many different assets. Most of those allocators you're talking about, they decided to put all their chips on multifamily over the last 5 or 10 years, and now they're finding themselves somewhat painted into a corner. They've told you that the best returns are in multifamily, but it's pretty obvious over the last year we're seeing a lot of those value add deals struggle to throw off much cash flow at all. So now they're having to walk back on all the things they've said and all the content they've created, that maybe multifamily isn't the best thing since sliced bread. Now you're going to start seeing them say, hey, we're making this shift to build to rent or even to other asset classes. I think what I'm doing is just from the beginning, I'm saying, hey, I'm just an allocator who has always been involved in multiple asset classes. I love Tony Robbins' book called The Holy Grail of Investing. If your listeners haven't read, that's a great one. And Ray Dalio has a quote in there that says, the Holy Grail is having 8, 10, even 12 uncorrelated assets that are just totally unlinked to Wall Street and investing in those and spreading your money out. That's true diversification. None of these sponsors who have blind pool funds with 10 apartment buildings, they can't compete with that. And I don't want them to, because here's the thing, Adam, when I help a sponsor. When I find a sponsor I trust, I want that sponsor to stay focused on his asset class. The best sponsors are going to weather the multifamily storm. They're going to come out the other side. The water's receding. We're going to see who's quote swimming naked, like Buffett says, but there are going to be survivors. And there's going to be people who stand up and say, we made a mistake on that asset in Houston. We did a stupid thing and took floating interest rate or did, those, they're going to come out and own their mistakes. And those are the sponsors that I'm going to seek out over the next 3, 5, 10 years to continue to bring them money. That's the way I see it. I want to provide a service to the sponsors. I want to make it easy for them to raise capital. They can go be a better operator, and maybe they can buy one or two more assets this year because we took some of the strain of raising capital off them. Maybe they don't have to hire an in-house capital raiser anymore. They can just use us. And we'll take care of that for them.
Interesting. All right. So your differentiating characteristic is a deep focus on diversification. And the reason I'm asking that, Kent, and we should move to wrapping up. We've gone super over. I can't believe it. I was thinking to half an hour. We're way past that. But I got some sign-off questions I want to ask you anyway. Um, is because one of the biggest challenges that I see is that a lot of allocators really just parrot, frankly, the same language. And you'll start hearing me parroting the same thing as I give this as an example, but passive, earn passive income in real estate, build your wealth with real estate. Here's how to retire with real estate. Everyone just says the same thing again and again and lob it up on a website with copy and pasted, templated everything and articles, and everything starts to look and sound the same. So it's really important to stand out. You've got to be yourself. So I'm going to ask you some questions because you're a very interesting fellow, and we did not cover a couple of things that almost, or one thing in particular, that almost put us off this podcast, postponing it today. I'm going to ask you that last thing. It's so cool. But before I do, let me ask you 5 quick rapid fire questions just to sign off with. Number 1, what has been the hardest lesson you've learned so far in real estate?
Oh wow, you in the world of development, you need to have good design. That's the one thing. If you don't, if you go in without good plans, without good design, you're gonna run into more problems. So that's probably the number one thing. That's more on the development side of things.
All right, that's good. What's been the best way for you to find active investors or to bring active investors into your network? What have you found has worked the best?
Yeah, I think just being out there, being myself. I have kind of focused in on Facebook.
Oh,
I may be making a shift there, but I've spent some money on Facebook in some unique ways. Um, Facebook counts views, and I could get in really deep on that, but there are ways to advertise inexpensively on Facebook. You can throw a video up on Facebook and not send the watcher of that video to a website. You can actually just say, hey, I just want to put this up there as an engagement ad. Facebook will keep up with how much of that video people are watching. It's really neat. And then you can go retarget everybody that watched 50% of the 5-minute video you created. And so that's a really, right there's
yeah,
a
it's
tip.
really sophisticated. Have you
Yeah,
found investors that way?
I have found a few, absolutely,
Mm.
I'm looking at different things, but you get call, everybody has calls that get booked and people don't show up. We've all had those problems,
Right.
but working through those issues, but and getting people to a certain point. But as well as I do, you have to test. You have to test the hook. You have to call them out. You have to call out your target investor. There's just so much, and you have to keep testing it till you finally find that one thing that works.
What are the biggest challenges you face at the moment in building your business? We should say the name of it for crying out loud. Hickory Creek Capital Partners. What's the biggest
Yeah.
challenge you face at the
I
moment?
mean, of course, I have this 3C1 customizable fund that can hold 100 investors. I want to fill my fund. So just like a lot of other investors or fund managers, I want to find more investors as well, because it gives, just like we've talked about, the economics. If I have a full fund with 100 responsive investors, I want to build a list of not just 5,000 investors who throw my email in the trash, but I want um, even 100 investors that really truly listen to every word I say and have that amount of money to allocate every year. Right? I think that's most of our desires, to have that database.
Find more investors, yeah.
Yeah.
What's the biggest misconception about the capital allocator model, Ken?
I think we kind of touched on that. I think it's that the capital allocator is another layer that's going to make your returns lower. And if
Ah,
you went into the deal by yourself, I think most people say, "Why do I need an allocator?" They're making my returns worse. Not necessarily. A good allocator who has that full fund that can bring $1 million check, they can negotiate better terms that make their involvement actually a plus for the investor.
and advice to somebody thinking about setting up their own fund of funds, capital allocate, getting into the business. What advice would you give them?
I think it's all about getting in the right rooms, getting in the right masterminds. Um, Take that time to create those relationships. I'm obviously a fan of Avestor. They make that part of it easy. Then you need to fix the deal flow side, and I'm a part of Connected Capital, which you've been on there quite a bit. So I think those two are like peanut butter and chocolate. You've got your fund, which you spend your money once, and you get to do a customizable fund that can handle 6, 8, 10 deals a year, as many as you want. And then you've got to have deal flow. And so I'm always looking for unique deals. Some of them come from different places, but I tell you, it's because of the rooms that I've put myself in. Some of those rooms are absolutely free. Some of those rooms cost a little bit of money to be in, but I quit saying that I'm gonna. You need to write the check and be in the room that you need to be in.
Kent, thank you for joining me. And we did delay you. We almost postponed because what exactly is going on behind that wall behind you? Just do please tell.
Well, Adam, I live in Tennessee. I would say your listeners and watchers are trying to figure out where this accent's from. I live on a hobby farm. It's a 12-acre hobby
Ah,
farm. We found it 10 years ago. It was our dream land. We made the housework. We did the renovations, but I'm in an office just off to the side of our home, and it borders a pasture, and we have chickens and cows. And I made the mistake of sending 3 calves to market yesterday, and I've really upset one of the mamas, and she's been outside my window all morning. So I had to take her and the other calves further away, and I don't think we heard them moo once, Adam. So
no, I'm kind
they're
of
a good
sorry that we
workout.
didn't. But
It would have been an interesting conversation because she's loud enough to be picked up on these mics. So
Kent Leach, Hickory Creek Capital Partners, it's an enormous pleasure to have met you, to get
yeah.
to know you, and thank you for being on the show today.
Oh, thank you for having me, Adam.
All right, that was Kent Leach of Hickory Creek Capital Partners. Kent, what a pleasure meeting you. It's been a real delight seeing you on the Connected Capital calls, hearing you express opinions and share your thoughts, and a real delight having you on the podcast today. I really appreciate the time. Thank you. And thank you to dear viewers for joining us today. I'm sure you found that interesting. And, definitely if you're in Tennessee, I'm sure that Kent would be more than happy to show you around his hobby farm. I say that presumptively. I hope you don't mind me saying that, Kent, if anyone gives you a call. And if you've not yet subscribed to my newsletter, just go to gowercrowd.com. You'll be able to find more information about Kent there as well on the podcast page. But be sure to subscribe also to my newsletter. It comes out once a week. You can always unsubscribe. And I cover insights into real estate investing, really from my own personal perspective. What can I tell you? I've been in the industry for a long time, and I'm trying to share some of my views to contextualize the investing that I'm going to be doing this year. Okay, thank you again for joining me today. But for this week, this is Adam Gower signing off.